And we'll go ahead and get started here. We have an amazing speaker on today. And we still admitting people here, but we'll go ahead and get started. Let me bring my screen up here and I'll go through just a couple items. And then before we introduce our amazing guest speaker today, first of all, this is not financial or legal advice. It's simply sharing what we do as professionals in our field. We are not soliciting any specific deal on the call, and the meeting will be recorded. So I guarantee it will be worth your while today with our guest speaker, Charles LeMaire. Old people, money problems. Charles has some amazing background around how to best utilize our money and how to save the most we can. And a little bit about Eagle City. We are apartment investors and operators, so we purchase apartments and open up deals to investors from time to time as they come available, as we acquire apartments. And a little bit about your hosts. We have Asif Kumar. I don't know if he's on the call yet. He'll probably be joining us here in a minute. We also, Nikki and Sanjeev Mall are part of the team. They're out of the country, but they're typically here. So a few weeks, they'll be back in town. So here we go. Let's welcome Charles LeMaire. A little bit about Charles: was an electrical engineer by degree, has a MSEE and an MBA. And at age 56, with no prior involvement in real estate, his wife dragged him to a real estate investment meeting at which both single family and multifamily were presented by a fellow named Brad Sumrock. Honestly, he didn't find single family at all enticing. On the other hand, multifamily syndications was very interesting. As Brad explained the ins and outs of multifamily syndication in detail, the math behind multifamily made sense to Charles and became students. And Charles will be presenting a very interesting topic this evening around apartment investing. And so, Charles, why don't you introduce yourself a little more and let's get on with this.
Fantastic. First of all, if you go back one slide, it's LE, because in French, that makes me feminine and I don't want to be. But anyway, past that joke, it is LE instead of LA. Now, we'll go on to the next one if you like. I don't know what was on there. Oh, no slides. Good, no slides. I don't have any anyway. So I am, in fact, 70. I actually spoke to the Social Security people earlier today. Fantastic for me. They're going to start paying me money. All of you that are younger, please work and put that money in there for me. Thank you. So the point I guess I'm here to say is that some people have been given a bit of a, well, they've been not lied to, but they weren't given all the information when they were told about their retirement accounts and some of the other surprises one hits when one gets a bit older. You know, if I were talking to just the gross population in general, most people won't hit these things, but folks that do what we do are typically going to be relatively successful. They're going to have a few bucks here and there. So you're not probably going to be squeaking by on Social Security if it exists, and just a few other things. You're going to probably have other issues. And so one of my big kicks is if you've got retirement accounts that force RMDs, required minimum distributions, if you're not aware of those things, be very aware of those, because they will cause you problems. If you've got large amounts inside your 401ks and or your traditional IRAs, just be aware that you will come back and it will hit you. Now, why is it doing that? I'm not, gallery, that's what I'm after. So the issue being is that, if you're completely out of these retirement accounts, then you don't need to listen to this part of it very much. But if you are still in either Wall Street or using these things to invest in properties, just be aware that if it's a traditional IRA or a Roth IRA, you do get hit with UDFI whenever you sell the property. And that will come as a big surprise. Now, I absolutely, I can't get anybody to come on and tell me what the real number is, but you might be getting taxed at 40%, or you might be getting taxed at 20%. I've heard it both ways, and I can't get an answer on either of those, but both of them are a little bit inconvenient if you're talking about IRA money. The second piece of it for both IRAs and traditional IRAs and traditional solo 401ks, because the solo 401k gets you out of the UDFI, but at some point when that happens, you'll, wait a minute, let me see if I can figure out how to do this. Somehow this thing turned into view. There it is. When that happens, you'll end up paying earned income tax rates instead of paying capital gains rates. And I think that's sort of the epitome of stupidity. Now, if you put it into a Roth, and if you can get it into a solo 401k Roth, then I think it's probably a good idea. So if you can figure some way to move your money into a solo traditional 401k, and then pay the tax to convert it into a Roth solo 401k, I think that's the winning strategy, because you don't get hit with the U-bit and you don't end up paying the higher taxes. And I would say that the traditional is not as good, because you end up paying a lot of tax on the gains, whereas the Roth you don't. And if you do the math, if you use $1,000, if you put $1,000 into a Roth account and you put $1,000 into a traditional account, if you pay the same tax when you put it in as when you take it out, it's dead even. There's no issue with that whatsoever. So, you would say, well, gosh, it doesn't matter. But I will contend that in all likelihood, if you're successful at this stuff, you're likely to be paying a higher tax. And by definition, our tax rates go up in 26. So I can pretty much guarantee you that you'll be higher rate than you are today. The tax rates go up and the brackets shrink. So, if you're making a certain amount today, you're going to be paying it at a higher rate. For instance, the 24% rate goes to 28%, and it's only 4%, but that's 4% of your money. And the higher bracket in point slides down about $100,000. So if you were near the top of the 24, you'll go to 28 for some of it, probably most of it, but you'll likely end up in 32, which moves to 35 for the top piece of it. And that's beyond inconvenient. So just be aware of that you might want to avoid having a lot of money in the future inside taxable events. You pushing it out to pay tax in the future is not necessarily a good idea if it's at earned income rates. Anyway, that's my 2 cents on that particular issue. And if you hit a question, go for it, whatever. So I strongly suggest, and again, if you're out of these things already, that's fine. If you're in them, you always pay the tax. It's just you want to pay the tax at the lowest rate possible. That's where you win. And I think one of the confusing things that people get suckered into these things, say you hit retirement age and you go, oh, I'm going to burn some of this Roth money before I start burning my deferred money, because I got to pay tax on the deferred money as it comes out. But as you push it out further, the tax rates will go up because it tends to grow. And as it tends to grow, it will push you up the curve because your RMD, required minimum distribution, is going to start off at about 4%, and it is going to grow and grow and grow as you continue to survive, such that as you take more out, it will force you to take more out, and therefore you will be pushed up the curves. Oh, okay, well, it might be even, but let me point out that this thing called Medicare comes back to bite you. If you're into Googling, Google the word IRMA, IRMAA. What it says is that, like me being a fairly wealthy person, I get to pay more for my Medicare. Lucky me. And for that, I get the better doctors and the, well, wait, I don't get the better doctors. Well, darn, I don't get much for this. So the point being is that, when I was working for TI, I believe I was paying $100 for my wife and I to get medical through the company. And clearly it was subsidized, no problem there. So then I retire, and now I get to pay about $400, a little over, per person for my medical. And that's because we tend to make a fair amount of money on this here real estate stuff. And so I just warn you that if you end up with those IRMAs, it will push you up the curve, and therefore the RMDs will push you up, and you'll get to pay more IRMA. And you sort of have to calculate that into, oops, I just paid a lot more fees and taxes than I would have. So there's where you call IRMA. The other one is on Social Security. And I have no idea what the future will hold for your Social Security. It was a better deal for people a few years ahead of me. It will likely be a better deal for me than it will be for people behind me. But, that just proves in my mind that politicians can't do math. They don't understand mathematics, and so they can't build a system that is going to be useful for a long period of time. Be that as it may. Oh, and then there's all these rumors about, they're going to run out of money. The dictate is that they pull in about 78% on a current basis. So yeah, you may lose, what is that, 22%. Doing math in my head is always dangerous. So there is that. But I flat guarantee old people vote. And when old people vote, Social Security becomes the third rail. And yes, I think they're going to have to do some changes to it, but it will be a really painful proposition. And sadly, just like everybody else in this country, old people got their hand out going, more for me, more for me, more for me. So I don't know how much it'll change. I feel very sure that there will be something in the way of Social Security for a very long time, assuming the country stays in place. And I assume it will. But be that as it may, you'll get something. So you need to sort of understand that Social Security in 1983 became taxable at 50% if you were above a certain income. Nobody in this room is going to be below that income, so count on the 50%. It is also taxable up to 85%. The math and the reasoning behind that is just completely flawed. It makes no sense, but that's politicians for you. So it is likely that everybody here will get to pay the 85% of it. But on the bright side, 15% of my Social Security and presumably your Social Security is tax-free. That's a good thing, I guess. So there is a thing called the tax torpedo. The common term for it is, and that is, as you're pulling money, again, out of a traditional account, you have to pay taxes. It gets added. Well, every dollar you could pull out adds about 85 cents to the tax rate, so that you're paying tax on $1.85 when you get $1. And so the effective tax rate during that little phase period doesn't last very long. It's typically in the 22% range, goes up to 45%. So there's a little range in there that you get to pay taxes at a 45% rate. If you can, if you happen to land in that area, be very aware of it. It's likely none of you will, but just avoid it like the plague. Take more one year and less the next, more one year and less the next. So you at least bounce back and forth across it, so you can get your money's worth, so to speak. Pay less tax for the same amount of money coming out. Whatever you want to say by that. Let's see. Medicare. I did RMDs. If you're
Charles,
yes, sir.
hey Charles, would you explain a little bit more about the R&D?
Sure.
You're going over it pretty quick, just so we understand.
Okay.
A little more about it.
A couple of years ago, when you turned 70 and a half, you had to pull out a percentage of what you had stored in it. The mathematics at the time was about 3.8%. And what they did is they had a life expectancy, and your life expectancy was, let's see, if it was 4%, it would have been 20 years. So it was around 19 or 18 years that you were expected to do it. You divided 18 years, maybe it's 22 years to make this work. Anyway, whatever the number was, it was around 20 years. So you took out about 4%. Is that right? No, for 25 years. It was about 25 years. So you took out 4%. They do it by division, which makes it very confusing and harder to talk by. If only they just told you the thing you multiply it by rather than the thing you divide it by. But essentially you had to divide your account such that you took out about 4% the first time at 70.5. They've reworked it a couple of times, and they've raised the age up to 72. I think I hit 72 at this point, and I'll move to 73. It was 72 for a year or two. I think I get to skip that and I'll move right to 73. So when I turn 73, I'll have to pull out somewhere in the neighborhood of about 5%. So if I got $1 million sitting in a traditional IRA and or 401k, and that does bring up something else, thank you for reminding me, that says I'm going to have to pull out about 50,000, add that to the top of my money. And if I were in a reasonable place, it's going to slide me up the scale and say, move me from perhaps 24% to 35%, or I guess it'd be after 26, it'd be moving from 28 to 35. And, I don't want to pay 35%. So, that would be an inconvenience. But if I had 2 million, all of a sudden it becomes 70,000. And, for people, I actually had closer to 2 million, and it would have grown a lot bigger had I not converted a lot of it. So I warn you for that. The issue being is if you let it run wild, it will get very big. And if you don't take care of it, once those RMDs start, it's not absolutely, but there's very hard to stop it after that point. You're sort of stuck with that tax or that RMD, required minimum distribution, because they want their tax money. So you got to keep doing it. So the choice is that you can do a Roth conversion now. You can take it out and just keep it in your pocket now, or you can just leave it in there, let it grow, and you'll end up doing the RMDs. And I hope that sort of is those are more or less the three choices you've got. So if you move it to a Roth by doing that conversion, then there's no tax as it grows, and you'll be able to take it out when you want to after a 5-year window until and after, I should say, or after 59.5. So if you're 58 when you do this, you really don't have much of a window. The 5-year clock goes away. If you have never opened up a Roth, that's a bigger problem because you do have a 5-year window on that. You cannot take out gains until it's been there for 5 years. So, go and open a Roth IRA right now. If you're in a 401k, one comment is, say you work for 2 or 3 people, you've got 401ks from various jobs in the past. Each 401k, you must take that RMD. If my number is 5%, I got to go to each one and pull out 5%. IRAs, on the other hand, can be aggregated. So if I got 5 IRAs, I can go out to one of them and pull all the money I'm supposed to pull out right off. But the whole point is that as it forces you to take the money out, you can, I lost somebody or gained somebody, I don't know, I guess I'm boring. Anyway, as you pull the money out, it gets added to your income, and therefore you get to pay tax on it. So I just encourage you to do the math and understand what that's going to do to you and avoid that if at all possible. There are people that will just yank all the money out today. There are people that will wait until they retire and pull the money out as they can with conversions, or they'll burn some of the money after they retire or something like that. I'm just saying perhaps not putting as much in there to begin with is a good idea. I'm a big advocate for get the match. And if you can get the match by using the Roth at some point in your career, that's a good thing. But just avoid thinking that, oh, that tax benefit I get today is all that valuable, because it will come back to bite you when you get gray hair, or in some cases, pink wide margins. Okay, let's make him go away. There we go. Oh, come on. That should make him stop. Okay, so there's that. So let's see, we can aggregate on one of them and not on the others. Now, if it's a Roth, they recently changed the fact that if you had a 401k Roth, you used to have to do RMDs, which made no sense whatsoever. The most recent ruling has changed that, so you can avoid RMDs on all Roths at this point, which is good. And Roths you can pull out whenever you want to. Again, that's pretty valuable money. It grows pretty much tax-free. If you want to use it on a house, that's a pretty cool idea, especially if it's a solo 401k, because there is no UDFI on that one. All right, did I hit that RMD stuff for you there?
Oh, yes, you did. Thank you.
Okay, all right. So it's
that's
just
all.
the government's way of getting their share, because whenever you have any kind of retirement account, you got a partner, any kind of traditional, you've got a partner, it's called the government, and they get to change whatever part's theirs whenever they want to. It's like having a lead in the property who says, I told you it was 80-20, but really it's going to be 50-50, dude. Too bad. That's pretty much the way that works. And they get to change it year by year, the dirty dogs. So,
Charles,
yes, sir.
Would you talk to us a little bit about your experience, like in some of the IRA investments or Roth? So
Yeah.
you're saying Roth is better. So could you give us a little examples?
Well, what I'm really saying is that I did exactly one deal. I used a traditional IRA, and nobody tells you up front, not Quest, not whoever all the people are, because they would like to get your business. And so they don't mention that UDFI up front. So all of a sudden, after you've been in the deal for about a year, year and a half, maybe 2 years, you hear all this mumbling about this UDFI. I went to my accountant. She said, "Oh, don't worry about it." I said, "I'm hearing too many rumblings to believe that." So I kept investigating. And in fact, UDFI exists. You typically won't hit it until you sell the deal. So let's say I put 100,000 into this deal. It's, say, a 5-year deal, and I'm real lucky. They pay me 10,000 a year for those 5 years, so I get 50,000. Excuse me, but that's still less than what I put in. So I really haven't had any gains at that point. So all of a sudden we sell this thing, and we sell it such that my share would be a total of 200,000. Shazam, I now get another 150,000 back, my original 100 plus 50 more in profit. Well, on this particular deal, let's say we had an 80% loan. So I get to take 1/5 of my gain. My gain was 100,000. So 1/5 of it was $20,000. And these are all in rough numbers, and there's some little nuances in here, but essentially I get 20 grand and stick that in my pocket and say, "Yay me, that's mine. I got 20 grand free." The other 80,000 of gain, and there is a stair step, but it's a very quick stair step. So once you hit about 10,000, you're at the 40% tax bracket. Now, there's been an argument that you get to use capital gain. I've never seen that proven. I've heard it before, but I can find nothing that corroborates that. So I'm going to go with the 40%, and I could be wrong, thinking this is 20%. So all of a sudden, that $80,000 of profit gets taxed at 40%. And off the top of my head, 4 8s are 32. So $32,000 evaporates and goes to Uncle Sam. The only good point is it's paid by your IRA, not by you. So, you do get to take the money out. You don't have to pay taxes on it at that instant because of that. There's a benefit there, supposedly. But somehow, now you're only making, and I'm having to subtract quickly again in my head. So you got 52 plus the 20 you got. So you only got $72,000 instead of the $100,000 you thought you were going to get. Yay, you. And it all sits inside that account. And so that 72,000 will grow and grow and grow. And then you get to pull it out at income tax rates. Bad idea. Now, if it's in a Roth, no income tax rates. And so that's good. If it's in a solo 401k Roth, no UDFI and no income tax. So that's why I would say that is the sweet spot. The problem with that one is you got to put the money into a solo 401k as traditional money and then convert it. You cannot. They don't allow you to take Roth money and move it into a solo. So just be aware of that. Did that hit it for you there, Herb?
Oh, yes.
Okay,
thank you
good.
for that. Great background. By the way, everyone on the call, you're welcome to ask questions.
Sure, hit it.
Anything about apartment investing. It don't have to be on.
It doesn't have to be old people, but that's just the topic I picked. I had to do another conversation. I sort of had this on my mind.
Right. Yes. Thank you, Charles.
Oh.
So any questions about we may not be able to answer them, but I think we can with Charles on here. So any questions about
while you're thinking of them, let me say that Medicare, it kicks in at 65. And, back if you have parents that were old enough, and I will say that my father was actually born in 1900. You may not believe that, but he was in World War I, the first one before that sequel that came out that was two. Anyway, he was an older fellow when he had me. But when he retired, the age was 65. And so everybody got their Medicare and their Social Security at the same time. So, you think, oh, wow. But now the going age, I think we're at the point where everybody's at 67 now. It was 65 when I did it. We had a 5-year period where it clicks over at, no, 6-year period where it stair stepped up to where you get to 67. So I think pretty much everybody who retires from now on will be at an FRA, full retirement age of 67. So there's a period of time you're on Medicare, but you're not on Social Security, where you could be, but you might not be. So I will stick in my 2 cents on this one. If you're married, think long and hard about filing early, assuming you have any kind of thing. The idea being is that if there's any longevity and there's not a lot of illness in your family, it is a huge insurance benefit. And by that, I'm saying it solves the problem of having some fixed income for your spouse in a post-Charles world or a post-Chris world or a post-Greg world, whatever. But, so I have waited until the end. And that way, my poor wife, who will be dancing on my grave, will get the most she can, because she doesn't like working with money. She doesn't enjoy playing with money. I do, so it doesn't bother me to do this, but she doesn't want to have to do the stuff I do. And so I tried to give her the biggest benefit. There are folks out there that go, oh, hit 62, which is the lowest age you can take it. You can do it. And if you need the money, God bless you, take it, whatever. I don't expect anybody on this call to actually be in the bucket of needing the money. There may be a few of you that say, I can take it and invest it. I'll come back to that in a second. I don't believe you, but that's okay. But essentially, by doing this, she gets, today it'll be a 3 times 8, 24% kicker. I actually get the 32% kicker. Like I said earlier, I'm getting a better deal than you will get. And my father he might have been old enough, he didn't quite get a greater deal, but people before me have gotten a better deal. Any case, so just keep that in mind, that if there's 2 of you and you're married, one of you may want to take early, and then the other person, get a little bit of income if that's what you need. And one of you may want to file as late. The higher earner should file as late as possible, unless you all know that you're both going to die early, in which case enjoy and do what you can. So just keep that in mind on that one. But there is a period of time that you may be taking Medicare and not taking Social Security. And then they send you a bill every month to pay that nice, big benefit. I should also mention that the Medicare cost is set 2 years prior. So you hit 65, you retire, and all of a sudden they look back at your age 62 when you were employed or whatever you were making at the time, and they go, aha, he was making a ton of money, so we will charge him the most we can. And then at 65, I do a big Roth conversion. And so at 67, aha, they go back to 65 and say, we're going to charge him a lot of money. And so, I have known for several years, because I was doing my Roth conversions, that I was going to pay a lot more for a period of time, and then it will evaporate, and it'll only be those properties and what I make on them that will cause my Medicare pricing. But, so you do have to plan, if you're going to do Roth conversions or just pulling the money out, that if you do it before 62, you're going to have to, or 63, I guess, it's 2-year look back. If you do it a little bit earlier, then perhaps you won't get a hit with an IRMA, but if you're still working, you'll add it to your regular salary and move up the curve that way. So it's always this mental thing about shuffling the money on the curve. You've got a certain amount that is standard deduction. You've got a certain amount that is income at 10%, a certain amount that's at 12, which will turn to 15%. And then it goes up the curve. So you just lay out your income laying on top of each other and say, I got this much of earned income and it's going to cause me to fall here. And then everything that you have as capital gains falls on top of that at either the 15% rate if you're low enough, or the 20% rate plus the 3.8 if you're high enough. So, it's not too hard. It's not a big mental problem on figuring it out, or at least estimating what those taxes will be and sort of going for where you can pay the least over time, realizing that if you pay the Roth now, or you do the Roth conversion now, you're saving yourself from the future of paying a lot of taxes in the future. Again, it's thinking about a post-Charles world when my wife is 90 and I'm buried probably, she won't have to have a problem. And that brings up this concept of the widow's tax rate. Realize that, when one of you pass away, if you're married, you have the same the same traditional IRAs, pro and con, before and after, if you have any. And so that income won't change. I will have the same rental apartment investments, pre and post Charles. And so, the only thing we will lose is one of our social securities, and my wife will be a much wealthier woman without me around, and she will lose one standard deduction, and she will slide up that tax rate, because if you look at the single rates, they don't have as long a brackets. And so she will get hit with a huge amount of tax all of a sudden. So there again, get the money out of those things that cause you to have income and probably put them into things that cause you to have capital gains. Play the game so that you're playing with a better tax rate involved. Let's see, I think I hit all of those things. So yeah, all right.
Okay. Yeah, anyone have any questions? If we can unmute you, if you would like to ask questions, there's a lot of experience and knowledge on this call. So anything apartment related, we'll be happy to talk.
Yeah, I wouldn't mind asking a question.
Please go
related to that. I'm kind of on the earlier side of the contribution curve rather than the drawdown curve. And I'm kind of just trying to get your view in the rearview mirror. Would you, A, put more money into retirement type accounts, or B, look at other kinds of ways to carry your wealth forward, like trusts, companies, and corporations?
The people on this call are all entrepreneurial like, and I don't I don't call myself terribly much of an entrepreneur. I started work in 1980, and in 1978 is when the traditional IRA and 401k, I guess it'd be the 401k that came online. And I bought into it hook, line, and sinker, but tax rates were fairly high at that point. So it probably did help me. Over time, those tax rates have fallen, not like a rock, but they've creeped down pretty well. And we're at probably nearly the lowest rates we've ever had. So if I were a person today, I would be really hard pressed to say I should go traditional today. I really think that until your income gets so large that you can't do an IRA, you should think about a Roth IRA. You should really think about doing Roth IRAs, and there's no real income restriction on 401ks. So I would suggest that unless your income is really high, probably up at the really top of the rates, and you do have a possibility of making less later, I would go for Roth today in any case. Now, your real question was, should I be in a retirement account or should I be out of a retirement account? Right. I'm a strong proponent, because of just my upbringing, that the retirement accounts up to the match, if you have a match, is a good idea. Past the match, I would certainly not do that. And that is because I've seen how much I can make in the property and stuff like that, but again, I didn't do a lick of property other than the home we live in until I was 57. Went to that big meeting and sort of fell in love with it, or at least started understanding it. And then we started doing it after that. And the returns have been much bigger in property than they have been in those Wall Street accounts. Everybody goes, oh, well, it's down right now. Yeah, it goes up, it goes down. So does property. It's a big loss recently, and if I happen to have been in there, that was sort of 100% loss. And there's people that go, well, I'd never leave us 100% of my property. Yeah, you could, you might not, so I have feet in both buckets, if you will. So, but if I were doing it today and I was a younger person, I would be getting the match for my employer and probably leaving that in Wall Street. And I would be getting and taking the rest of it and sticking it outside so that I could save up enough to play in real estate. Now, that's just me, and I have my biases.
Yeah, I certainly have had the runway. So what I have done is I've taken the 50% match. So I'm getting cash at 50 cents on the dollar.
Yes.
So, you can really get, you can run through the ups and downs of the share market, but those ups and downs have pretty much made it go sideways. So what I did very early on is I took it out. I took my tax pain early on, and I turned tens of thousands of dollars where I contributed 50% of it. I took my taxes out because I took it long before 65, but I turned it into millions of dollars through real estate and through investing in other companies. So when you've got runway, you know, my view, and if you're an entrepreneur and prepared to take risk, is you take the whole out. You take Uncle Sam out of the picture 100%, and he makes you know, the government makes none of the rules, none of the impositions. You don't have to worry about taxes changing in the future. And I think you get more control over your own destiny, but I don't recommend that for everyone.
Right.
But it's certainly been successful for me, and I've had the time to earn it back if I blew it all up.
And the point being is, people that are comfortable being an entrepreneur, yes, I am a little less comfortable, but much more so than some of my friends. You know, I've talked to people that think I'm nuttier than a fruitcake with what I do. So, you know, they're just all, you know, and they're the kind of guys that go all money market. And I'm thinking they're never going to get there at that rate. So, you know, you've got to take some risk if you want to get some reward. It's just, where are you willing to take that risk? And some people are just, they got blinders on because they've been taught the stock market and they can't think of anything else. And, you know, if they're going to stay in the stock market, I would go with these kinds of accounts, because you can do a little bit better, Roth being the better choice. But if you're going to do real estate and you can get the money out, that's fine. And then, you know, if you do want that money out, you know, you can get it out without paying the 10% if you go Roth conversion. You can convert it. It takes you 5 years, and then you can pull out the donate part. You know, so that's one way to avoid the 10%. It may not be worth it to wait that long, but, you know, some people are just, oh, I don't want to pay that 10%. Well, I'll give you an offer. Here's a way you can do it. If they're a bit older, you can do a 72T. You know, you have to do a minimum of 5 years at that also. But, you know, if you're in the, let me count back here, if you can pull it out at 59, you know, if you're in your mid 50s, that 72T gives you some money up front each year to invest in different properties. You know, realizing that I'm an LP mostly, I'm not a GP, and I call that LP as a lazy person. So, you know, it gives you some capital to invest that way. You know, clearly you're a much bigger entrepreneur than I am. So, you know, it is not wrong what you're doing by any stretch of the imagination. It's just, everybody has to gauge what they're good at.
And just to compare the difference in taxes, equity has exactly 0% tax as long as you don't sell. You can grow it as fast as you want, and the government doesn't hold you back. And you can sell it whenever you want to realize it. And at that point, you have a taxable gain. It's, in my mind, infinitely less risky than an IRA. Now, that's just my personal perspective. Everybody has a different approach to the way they look at the market, but I kind of excited by the fact that I can grow it at whatever unlimited percent my efforts and strategies allow me to. And while I'm growing it, there is 0% tax in any way, shape, or form. And there is a possible even way, several ways to exit my equity gains and pay 0% tax on that, like 1031 exchanges and selling the shares versus the underlying asset. So, you know, the government can literally never touch my gains in that perspective.
Well,
Yet,
that brings
I always felt slaved to the whole 401k piece, because every other year the government decides exactly how they want to treat my money, and they can, with a stroke of a pen in the Senate, decide to cancel everything I've worked so hard for.
Comparing a brokerage account to a retirement account, that retirement account does not get a step up in basis, and you will not pay tax until you do the withdrawal. And so you are essentially setting yourself up to pay taxes when you're least capable of paying them, back when you're older. Now, you may have plenty of money, but it's going to cause you some heartburn when you do it. If you know, even if you bought stock and not property, you can hold until you're ready to take the gain, and it becomes capital gain. So you got exactly the same issue in the stock market. You know, I'm not saying I like one over the other. I'm just saying the rules are sort of the same. You do not have the 1031 kind of concept, so you can't push it out and play games of rolling it. Now, there are some techniques like loss harvesting and gain harvesting where you can play some games there. So people in the market do have some techniques, but
Limited,
everybody outside of those retirement accounts gets that step up in basis. But if you've got a retirement account, there's no step up in basis. The tax remains the same to your heirs. Now, you know, the problem with the step up in basis is you're dead, and that's sort of a side effect, you know, that you don't really want to pull on yourself.
There's a step up in basis on the markets if you're investing in shares, because it's highly regulated, because the government doesn't want to miss out on something that's so easy for retail investors to do as an alternative. No, but in the real estate world and owning your own corporation, your equity growth is not taxed or regulated to the same extent. So you can do what you want for the most part.
You may be right, but I mean, if I bought a share, you know, I've got some shares that have been in there for 25 years, and I've never paid a cent of tax on them. So, but when I sell them, I will get to pay a capital gains tax on them at that point. But if I were to pass, again, post Charles world, that says that the price of that thing gets reset, my wife gets it for free, or my kids get it for free, no tax. So I mean, it sort of works the same for that way, but the 1031 disappears. But I just point out that in that retirement account, you're screwed. You get it stays at the same value. It does not get to step up in basis, and your heirs get to pay the tax on it because they're not going to let that money go without paying that tax.
Exactly.
Yeah.
Thank you, Charles. Anyone else have questions?
Thanks, Charles.
Karina is one of our partners on one of our deals, and or Greg. Any
Hi.
think of? Hi, Karina.
This is great information. I'm taking it all in, and it just shows I have a lot to learn. So I'm enjoying these calls. Thank you for putting them on.
When I was younger, I was about 50, and I thought, at some point, probably about 45, at some point, somebody ought to start looking at my retirement. And I figured I was the only one that was going to do it. So I went and studied Social Security so that the lady sitting across the desk wouldn't be able to screw me too badly. And I started looking at Medicare. Medicare is harder to figure out. And then, started thinking I better start paying attention to my investments. And then my wife dragged me to that meeting, and I'm going like, hey, this is pretty cool. So, it has worked out rather nicely. We right now, past few years, we've had the cost segregation and bonus depreciation, which has made it really nice. That will be disappearing. And so I warn people, if you're getting into this new, and you're not a real estate professional, it's not really going to do you much good. So don't fall prey to that one. But for we who have been here for a while, it is going to be it's still lucrative, and it will be lucrative for a bit longer. So, that's a really nice thing. And it looks a little bit like a mini 1031 to me. So those things are good.
Charles, do you have some examples of Greg? Go ahead. Do you have a question?
Yeah, I've got a quick question for Charles. They're fixing to start a matching 401 at my company.
Mhm.
If I had an option to either take that Roth or conventional, what would you do?
You look a little bit more advanced, and so I would say that I'd still go for the Roth. Right now, I don't know what you make unless you're really at a high tax rate. But if you're making if you're in the 22 to 24% tax rate right now, I would stay down in the Roth stuff.
Got it.
In 26, the tax rates ratchet. They go back to pre-Trump. They will change the brackets to take into account the change in incomes, cost of living, but the actual brackets, 10 will stay the same, 12 goes to 15, 22 goes to 25, 24 goes to 28, 32 goes to 35, I think it is. So I mean, you can see that right now, you're going to pay taxes at a better rate today, and you will for a couple more years than you will in the future for sure. I mean, just by definition, because they can't, I suppose we could re-elect somebody who put it back in place and it would last longer. But, as much as I might cross my fingers, we don't know that that's going to happen. But there's that.
Charles, what do you think the chances are here of kind of an election bribe in the presidential election year that they'll kind of reinstate that?
I would never underestimate the stupidity of people whose group starts with a big D to elect somebody who is incompetent when it comes to finance and economics. If we were dumb enough to re-elect Obama, and if I insult anybody, I apologize. I just really do think this. If we're dumb enough to re-elect Obama, and we were dumb enough not to re-elect Trump, we got rid of mean tweets and we destabilized the world. So I'm not sure that was a fair trade. But I have friends that say it was worth it, and I'm going like,
no, I'm not caring or having an opinion on who's in the White House. I don't think it matters a whit. What matters is whether Congress and the Senate approve these benefits to us, through their various sessions, either as an election bribe whatever you want to call it. What do you think would happen
as
from
an
a
election-
policy perspective? The,
Well-
the White House is just, some random thing
Well,
that
I
keeps
mean-
the news cycles going.
Realistically speaking, the Republicans, and I love Dan Bongino's statement, there are no Democrats that are Republicans, and there's a lot of Republicans that are really Democrats, but be that as it may, the most that the people in the House can do is investigate and push through things that will be not done by the White House or not done by the Senate. So they really don't have power to actually enact anything, but they have plenty of power to stop anything. So, I mean, thank God for that in so many ways, but they really can't cause any changes.
Okay.
We had a recent deal where you had an election bribe to a lot of young people that we will pay off your student loans. Dumb as a post. Thank goodness they didn't do it. There's everybody's got their hand out in this world. It's just sort of sad. But I don't think you can get election bribes from the Republicans at this point. The Democrats, you can try to get some if they're executive orders, but they can't. Democrats can't push anything through the House. Republicans can't push anything through the Senate. And they're also stopped at the White House. So executive action is one place, and then you got the court system that everybody wants to slow them down. And I find it hilarious that if the courts say that something Trump did, if one judge says something Trump did was just terrible and you can't do it, that's wonderful. But if one judge says something that Biden did is terrible and you can't do it, that's a terrible thing. It's just humorous to me how we can not think the same way in so many ways. It's just, well, anyway.
Well, stalemate is good
Yeah.
for innovation because at least we've got certainty of regulation, right? Because they can't pass anything, cancel anything.
And that was one of my complaints about Obama. Every time we got the taxes almost stabilized for his 8 years, as soon as it looked like it was stabilized, he'd start talking about tax rates, and he would, scare the hell out of all the business owners. And we had employment problems, not huge ones, but employment problems and everything else. And it caused us to have a really marginal, if not mediocre, economy, as we're back to now, pretty much, and so it's just sad. I would, I hate to say it, but I'd rather have somebody in there that understood economics, and we don't.
I think we are in a worse position. We are in a worse position. It's going to be bad. It's going to be bad. It's going to be very, very bad.
Well, the biggest problem I see on the horizon is the petrodollar might become the petro yuan. Ever have to pronounce that?
No, I think it'll be the petro peso. That kind of rolls off the tongue a bit better.
Oh, it could be, but as soon as we lose the monetary system, we really will have some big problems over here, and I don't think people understand how bad it will be for us in that case. So there is that. And
Well,
that
we want to try to keep this as politic neutral as possible. But,
Apolitical as possible.
That will be
yeah.
the second section, man. That
Yeah.
will be the next section.
But
right.
they've already done deals for oil in Saudi Arabia on the yuan. I can't say that well, but they've done that. Whereas it used to be always petrodollars. So that spades have been broken. So I don't know that that's political. That's sort of current events. But
Right.
So anyway, on apartments, on the other hand.
But an apartment, our debt and our revenue is all based in dollars, so we're not really exposed to the whims of international, except for basic consumption of our tenants. But I strongly think with the US dollar is still considered a safe haven, is an enormous opportunity for us in multifamily.
It gives us that, but that has been what allows us to overprint and screw around. So in some ways, it might be great that we can't print too many of them. But on the other hand, that takes away a lot of the controls that we have over the rest of the world, where you can cut people out and force them to do things they want. We won't have the power that we once had. People can argue, oh, those nasty Americans, they wield too much power, but somehow I don't know that I would like the Ruskies or the Chinese running the world rather than us. I am against communism and I like capitalism, and somehow I'll fall to that every time. If in fact capitalism over
It's going to be entirely new world. It's going to be different impact if this is going to be happen.
Yeah, we'll negotiate with diplomats instead of our military at this point. So
Well, you have a flood of the dollars.
It'll be a brave new world. Very exciting.
Yeah. You will have a flood of the dollars here coming back. So that's going to be different impact of the, people will have a lot of ton of money, and then then the value of the dollar is gonna be rock bottom, and it's different. Well, I wish it's not gonna happen. Because I love my dollar.
Question
Yeah,
for
go ahead.
Charles.
Go ahead, please.
Do you have any, anywhere that you would recommend to read up more on all of the IRA and Roth things? I'm very unfamiliar with it, and my husband has money in 401k, and I'm trying to figure out what to do with it. Do you have any
Yeah.
websites? Because
Okay, there's several people that have good YouTube channels, and I guess that's listen up instead of read up. I mean, you can do it online, you can read it, but it might be more much more easy to swallow if it's like a YouTube, because they actually do pictures and whatnot as they go. I like there's a couple of guys out of San Diego, and they cater a little bit more to older people. It is Your Money, Your Wealth. There's a couple of guys out of Franklin, Tennessee, and they're called the Money Guys. They typically do a show that's topical. So, type in Roth and you'll hit the ones you want to see. If well, IRAs and Roth, they can be done that way. There's a fellow, and I believe he's out of Houston. He's got one that's really good. I can't remember the name of it, but if I put my email in the chat, if you'll send me an email, I'll get the one I'm talking about. And I would not take my money and put it with him. I hate to say it. I mean, he's probably a wonderful person, but this particular one this particular YouTube video caught my eye because he goes through a ton of the math. It's, whoa, did I lose that? What did I do? Okay.
No,
Anyway, he
that's
goes
me.
through a
We're
ton of
getting
math
ready
and
to wrap it up.
oh, well, I gotta quit, huh? Okay, anyway, it goes through a ton of the math, and it's not necessarily easy to follow, but if you listen to it a couple of times, he really does talk about the mechanics of the things you'll hit as you go on. Mostly he talks about people retiring, but I think that would be a good one. But I've got a half a dozen of these. If you'll send me an email, I'll just ship you these URLs and you can look through and play with it.
that would be great. Thank you so much.
Yeah. Karina, do you have his email? Do you need for the connection?
It's in the
Yeah,
chat.
I need it. Oh, it's in the chat?
I think
Yeah,
it
he
is.
posted it earlier. And thank
okay.
you, Nick,
Oh,
for posting the link on the Money Wealth channel.
There we go. I got it.
You're
Thank
welcome.
you so much.
Hey, is this gonna come on the dollar?
huh?
It's gonna be a dollar bill, right? $10 instead of the banks.
Oh, yes. Yes, we're just about ready to announce one lucky winner for today.
If you do want me, and I can't imagine why you would, because I just sort of ramble, but if you do, please use the email. I am not a big LinkedIn person. Thank you.
Oh, just
Email
keep
versus
spinning, man.
LinkedIn.
Come
Got
on.
it. And everyone, just wanted to announce the link that Nick posted in the chat for a YouTube channel. And we are about to announce one lucky winner for a $10 Starbucks card. And there it goes. Watch out. Look at
Oh,
this.
Ty, no.
Jay, are you still on the call?
I am
think
still
you are.
here.
Look
Can you hear
at
me?
you.
Thank you.
Now you can stop on a Starbucks to get a coffee.
We will email you a Starbucks gift card, and all you do is open up your email when you're at the Starbucks and let them scan it and buy some coffee. So we'll forward that to you within the hour.
Thanks very much. I appreciate it.
It says Jay's iPhone. I just want to be sure we have your email in our so if you registered, we do have it. I just want to make sure I send it to the right person, the correct person.
Charles LeMaire. Okay.
Yeah, yeah, right. Okay. Well, that was thank you so much, Charles, for all the information, education, and thank each one of you for joining us. And we'll be back on next week. Okay, Jay, I see your email. Thank you. All righty. Everyone have a great night.
Thanks, Herb.
Bye,
Thanks.
guys.
Next time.
Thanks a lot.
Thanks,
Bye,
Herb.
Bye, Chris. Bye, Karina. Bye, Greg. Bye, Jay.